Hey, Money Vikings, welcome back. And I've got a pretty good one for you today because I want to talk about one of my favorite ETFs. This is a very popular ETF, but it's for good reason. And I'm going to explain why I'm continuing to hold, add to it, and to also just enjoy the compounding growth of it, and why I think it's a great foundational investment vehicle for the future. So, a lot of financial gurus will talk about investing and saving and cutting costs and what percentage of your income should be going to housing, what should go to car payments and student loans and food and all that kind of other stuff. But a lot of times they can be lacking in exactly what investment vehicles they're using. So I want to dispel that here and share one. So this has been a part of my portfolio for quite a long time. I really like this. It's Schwab's. It's right here. I'm going to go into some of the exciting news that it's splitting basically. So if you own one share, it's basically splitting into three shares. Now it does decrease the value of each share, so you don't make any more money off of that. But I've in general found that over time, stock splits can be quite lucrative. They can really help speed up the compounding. If you are having the dividends and all that reinvested, it basically buys more shares over time. And I do think that stock splits can be pretty cool. So it lowers the per share price. And that does typically, a lot of times, if it's a sound investment, it attracts more buyers to buy it at that lower share price. So let's first go into what Schwab's US Dividend Equity ETF is. So the ticker is here. It's SCHD, as you can see. And here are some of the top holdings. So, and I wouldn't get too fixated on any one of these, but the idea is they are very strong companies that provide a solid dividend, and they have a track record of increasing their dividend over time. Why is that important? Well, number one, I think it's important because it shows that a company is profitable, and it's so profitable that they can actually send some of the profits back to the shareholders in the form of a dividend. It's also kind of exciting to see dividends in dividend reinvestment plans. So when those dividends are buying more shares, it's just on autopilot when you set it up. So you're basically just buying more shares each time the dividend hits, usually once a quarter. But anyway, let's go into some of these companies here. We're just going to do an overview. Verizon, Cisco, BlackRock, Texas Instruments, Pfizer, Chevron, Bristol Myers Squibb, Lockheed Martin, Coca-Cola, AbbVie, PepsiCo, US Bancorp, Oak, I think it's Pipelines, Kimberly-Clark, Ford Motor, Valero Energy, et cetera, Hershey Foods. You can just see here. The point I'm trying to make with showing you this is not to go talk about any one of these companies. It's to show you how strongly diversified it is. So instead of just trying to bet on one of these companies, basically you're holding a basket of all of them. And essentially, if some of them go down, that's fine, but some of them will go up. And they're all pretty powerful companies, strong companies. They're providing a dividend that adds to the value of the ETF as it's going forward. So check it out. You can see a lot of that. But I do like the 3-to-1 split that's coming. So I want to talk a little bit about this article too. Brad Thomas is from Seeking Alpha. He is one of my favorite analysts for REITs, for real estate investment trusts. I've followed him for years, but he does a nice overview here, summary of the Schwab 3-for-1 split. So he talks about Schwab Asset Management announced a 3-for-1 share split for 20 ETFs, including SCHD. And essentially he says here that makes it easier for investors to purchase the shares. SCHD offers a diversified portfolio with 3.4% dividend yield. That's a pretty healthy yield, actually. That's not bad. So right off the bat, you're getting 3.4% back. And a 12% 5-year dividend growth. That makes it a strong complement to a tech-heavy portfolio. So what he's trying to say is if you're like S&P 500, S&P 500 is very skewed now towards the Magnificent Seven tech companies. A lot of the weight now is in those. Well, this adds a little more diversification and should hopefully smooth you out if the tech hits a bumpy road. That's the idea. So Brad talks here about SCHD's top holdings, Home Depot, Verizon, the point being that they're high quality companies. And he does acknowledge here that some of these are probably a little bit highly valued right now. So something to keep in mind. And he says, despite some overvaluations, SCHD remains a long-term wealth compounder, benefiting from a diversified sector exposure and strong dividend growth. So anyway, this is an article worth checking out. You know, Money Vikings have done over the years a lot of, so the complement to this, I've also enjoyed the VDADX or the VIG, so the Vanguard Dividend Appreciation Fund. There's a mutual fund and an ETF version of it, but it's kind of the same idea. And in my mind, this is a really nice foundational investment vehicle because it is so well diversified. It's in typically very strong companies, and they're companies that are intent on paying back and paying some sort of dividend back to the shareholders. So I think that's all very important. And this is just another example of a simple way to build wealth using a vehicle like this is very helpful. And I want to look at a chart of, let's do SCHD chart. Let's look at the growth of this one over the years. Let's go 5. Let's go max. Let's max this out here. So this is an example here. Let me just show you. So you're going back over 10 years and look at this just very nice sort of, it's the little, it's not the little engine, it's a big engine. But the point is, it's just a slow and steady grower. Yeah, we've got some little anomalies here, like this was the COVID pandemic here when you have this March 27, 2020 drop. But look at this, just bounced right back up. So if anybody freaked out at the bottom and sold all of their SCHD in the pandemic, wow, they really lost out. They were a forced seller there. And look, they lost out on all this growth. Now it's been a little bit flat for a couple of years, but it's been paying the dividend, which is valuable. And as you can see here, we're getting more of an uptick here in the last couple of months as it sort of has another uptick. But again, just trying to show this very nice, sort of, again, it's nice to find investment vehicles that are like this and they have that kind of like slope. Now, I mean, you can get investment vehicles that have a lot of volatility. Bitcoin, right, has a lot of sort of crazy ups and downs. But this is kind of a nice like sleep at night thing where if you're dollar cost averaging into it, if you're allowing the dividends to reinvest, if you're compounding the growth on it, I think after a couple of decades, a person that is consistently putting some of their capital into this investment vehicle is going to be just fine. It's just a really good, solid, hard charger right there. And I think that's why it has such a great following. People really like it for its whole angle. Is it always the most exciting thing? No, not really. But I don't know, some people aren't really looking for a lot of excitement when it comes to their investments. They're looking for the tried and true, slow and steady approach, which stands the test of time, frankly. So, hey, thanks for checking out the video. Please like and subscribe, and I'll see you all on the next one. And let me know what you think about SCHD. Are there others like that you think are better or similar? I would like to know. Thanks. See ya.